Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle, as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals. In the intermediate term, risk, and the short term is about confidence and sentiment. This month, I would like to update you on developments in our 2018 Strategic Investment Insight categories. As such, I would therefore like to cover the following subjects outlined here. In this mid-year update of our 2018 Strategic Investment Insights, I want to follow the structured investment approach we outlined in our recent June LONGWave video entitled A Structured Investment Approach, represented here graphically, and our last Under the Lens video entitled Macro Investing in an Era of Political Discord. Starting with credit, we need to remember that credit isn't a specific market, but involves multiple trading vehicles with complex relationships, which we previously outlined. As I've said many times, we now live in an era of creditism versus traditional capitalism, where the credit cycle now controls the industrial economy and to an ever-increasing degree the business cycle. The global credit cycle controls national economic cycle as money and credit is borderless and moves in milliseconds. In our May LONGWave, Follow the Cycles, and other videos, we have offered a number of credit cycle roadmaps and key indicators within them to watch. I think this particular cycle diagram offers us what we need to kick off our review of our 2018 Strategic Investment Insights. The last time I showed this chart, we positioned the U.S. credit cycle where the red arrow is shown. We additionally labeled the fact we were beginning to see signs of risk reversal and building inflation in the bottom right box. This is where the arrow is today as we talk. I am now seeing early signs of flight to quality in both U.S. Treasuries and the U.S. dollar, our fourth stage in this particular illustrative roadmap. I've been posting a steady stream of developments on the MATA SII site regarding both risk and inflation, both domestically and global. Concerning risk, we see that the global risk appetite is in clear a free fall as we have witnessed in a long time. The red circles contrast our current situation to the 2009 financial crisis, the 2012 EU banking crisis driven by Greece, the 2015 U.S. taper ending and the fall in emerging markets and commodities, and the 2015-2016 Chinese yuan currency devaluation shock. I sense that the inflation genie is presently quickly getting out of the bottle, but it may be even worse than what John Williams at ShadowStat sees it to currently be. His work shows U.S. inflation at just over 10%, using the 1980 government basis for calculating inflation before all the hedonics, substitution, imputation, proportional substitution, and other statistical obfuscations were implemented. What few yet appreciate is that the Trump trade tariffs are effectively a U.S. consumption tax. Trump's tariffs on foreign products increases the price of those import prices that must be absorbed by the importer or the final user, the U.S. consumer. You can fully expect that 90% or more of the tariff costs will be passed directly onto the U.S. consumer. The U.S. government gets the increased payments in two forms: the full tariff increase at the time of the importation and the sales tax on higher costing products, the sales tax being paid to the state. Foreign exports may slow, but the importer or the consumer who uses the goods and services will pay. This is called price inflation. Hold on to your hats, as this could get ugly quickly if the master of the art of the deal doesn't resolve things quickly. My back-of-the-envelope calculation indicates that tariff price increases could quickly match the recent U.S. tax relief for individual households. A coincidence or a strategy? You decide. The world recognizes what is going on as shown by the dramatic increases in sovereign credit default swaps globally, as illustrated in our latest World CDS update shown in the right-hand side of this graphic. What this is translating to in the world's risk-free benchmark, that is the 10-year U.S. Treasury note, is the beginnings of a flight to safety with U.S. bond yields falling and their prices rising. We have been anticipating this at MATA SII with our 2.6% call shown here. This unfolding shift is likely to develop in two legs, with us just now beginning the second leg down of a classic ABC corrective move. We are additionally seeing, as expected, the high yield or junk bond market beginning to break down before what is likely to be a cascading drop lower at some point. The signals and patterns suggest that the bond and credit markets are likely to unfold in the fashion illustrated here. The late cycle predictability is why the bond and credit SII is one of our top 3 2018 focus areas. It is why we increased their focus at the beginning of the year. We showed this chart during our last update. What we have added is the fact that with a rising US dollar, the cost of hedging for the carry trade has made the purchasing of U.S. Treasuries very expensive and is presently restricting the carry trade in buying U.S. Treasury securities. Therefore, the flight to safety driver is not getting its assistance from the carry trade, and hence bond yields are not currently getting hit as hard as they might have. I expect this to change. We'll discuss that in a moment. Another higher focus SII is the lenders. Our call on shorting Deutsche Bank last year has turned out to be a major win. We see a lot more pain to come in the global banking arena, and specifically European and emerging market banks. What we have is a serious euro-dollar shortage, which is seriously impacting the global strategic financial institutions. The euro-dollar shortage isn't presently getting much attention, but these major banks and financial intermediaries are getting steadily hammered since the risk-off shift occurred in late January. Nothing points out this shift in global risk off better than when Bitcoin reversed direction, shown here in gold and the red arrow. We have seen approximately 10 trillion in world equity valuations evaporate since this January peak. Shifting to currencies, the third of our 2018 top 3 focus SIIs, we see here a chart of the US dollar. The US dollar has steadily fallen since Donald Trump was elected president and only recently reversed. The reversal coincides with the U.S. implementation of quantitative tightening, while the other major global central banks were further behind in various versions of their own taper programs and still are. This and higher U.S. Fed fund rates has triggered the lift in the U.S. dollar, along with an increasing risk-off flight to safety, which I mentioned earlier. The bottom in the US dollar coincided almost exactly with this dollar chart we drew a few years ago when we exited the first ellipse on the left. If this pattern continues to be as predictive as it has been, then we can expect some consolidation in the US dollar before it explodes higher to the high probability trading zones shown. Our short-term consolidation expectations are shown here. We need to complete the final C leg, which appears to align closely with the touch of the ellipse shown on the previous slide. We think the near-term buying of the US dollar has presently been overdone and is reaching a reversal point before going higher. This chart we also showed in our last update. The major change is the degree of euro-dollar shortage being caused by developments in the emerging markets, the EU, and China. The euro and the Chinese offshore yuan continue to be extremely weak against the US dollar, and we don't see this getting any better soon. In fact, it could get seriously weaker in the near to intermediate term. Shifting from credit and currencies, let's take a little closer look at the bond market, which we touched on earlier. We showed this chart previously, but we didn't focus on the expected lift in yields after the ABC is completed. We see a major push higher in yields due to inflation and supply. Don't underestimate how much a tariff war will mean to price inflation. There is a chance we are too conservative on the degree of lift to expect in U.S. 10-year Treasury yields. We suspect at 3.3% the Fed will step in, whether officially by stopping rate hikes and quantitative tightening or in some other stealth manner, probably centered around the dollar. What we are watching closely in the bond market is the ratio of the SPX to the 10-year Treasury note on a log basis, as shown here. We have a pretty clear head and shoulders pattern. We've done a lot of spreadsheet ratio modeling with the SPX and 10-year yields and are surprised to see how important the neckline shown here is and what a break of it would mean to both the equity markets and bond markets. We don't have time here to take you through these perturbations, but what we concluded is that there is a high chance that we will see something that is eerily reminiscent of what preceded the 1929 stock market crash. The 1929 stock market crash was based on an out-of-control, highly leveraged U.S. credit cycle with global currency investment flooding the U.S. It led to a late-cycle, last-gasp higher move in stock prices based on monetary policy accommodation before abruptly plummeting. When you recognize that 4 stocks accounted for 84% of the 2018 S&P upside in first half, you have to appreciate how fragile and dependent the equity markets are. Additionally, in total, corporate stock buybacks accounted for nearly all stock appreciation in the first half. Stock buybacks and ETF index impact is a potentially very serious looming problem, but maybe not imminently. We continue to believe there are serious cyclical and finance issues in the auto sector. The U.S. consumer is tapped out, with wages not staying abreast of the real inflation rate. This is not a new problem, but it is getting worse quickly when you add possible trade tariff price increases to this. It is going to hit already troubled retailers under financial and margin siege. We continue to see major short opportunities in this sector. You may want to revisit our extensive watch list with annotated charts for ideas. Defense has been a star for us, but we think most of the good news is priced in now, and the dividend game has been effectively played. Infrastructure is likely to again become a major talking point after the midterm elections this fall. It is time to do your diligence, though waiting to the fall may be the best bet. The FANG and NOSH SII has been a spectacular SII for us, but we now stress caution. We noticed that even Morgan Stanley today issued a rare sell downgrade on technology stocks. Again, caution is advised. In our view, the Minsky melt-up is not over. There is more to go, but the tide is steadily going out. We feel that the Trump tax cuts bought the market another year, but a trade war could take that back abruptly. The tectonic forces we outlined in prior updates are steadily shifting. The pressures of an ending debt supercycle will soon win out over competing central bank monetary policies. It is only a matter of time before the earthquake from these forces manifests itself within the global financial markets. We encourage you to examine the just released market reversal zones and bias outlook, which ties all of the above together. We don't show it here since we keep it strictly to the subscriber side of the site. The chart shown here is a dated illustration only. As I often remind our listeners, remember, they will print the money to solve these and any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are effectively trapped by policies of unsound money and fiat currencies. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2018 be an outstanding investment year for you and your family. I thank you for listening.